Today, a wild session for the U.S. stock market, complete with massive sell-offs and equally seismic recoveries. Plus, gas prices are set to rise as the 5,000-mile-long Colonial Pipeline remains largely offline in the wake of this weekend's devastating cyber attack. And finally, Ethereum soars higher this week, setting a new all-time high as crypto interest keeps climbing. I'm MacKenzie Sigalos, and this is CNBC After Hours. It's red across the board after a day of whipsaw trading on Wall Street. The Dow turned in its worst daily performance since February, as it finished down more than 470 points. And the Nasdaq closed nearly flat in a stunning reversal after the tech-heavy index was down more than 2% in the first half of the day. We also got some fresh economic data this morning, and one persistent issue facing the country is a stubborn yet puzzling labor shortage. 44% of small businesses are having trouble finding employees to hire for open positions, according to the National Federation of Independent Business. Job openings, well, they're also at a record high, according to the latest JOLTS survey out this morning. But at the same time, unemployment is much higher than pre-pandemic levels, and last week's jobs report was massively disappointing, adding only about a quarter of the expected number of jobs. Jeff Cox broke down the disconnect for us.
So the March job openings and labor turnover survey, also known as the JOLTS survey, showed that we have over 8 million job openings in the country. So that is a new record. And it shows, again, this incredible demand for labor that U.S. companies have. And we're still not meeting it supply-wise because we only have about 6 million or so hires for the month. So it's showing that there's still this incongruity between what businesses want and what labor can provide at this point. We're way farther ahead now than we were back then. If you remember the April of 2020, we saw an unemployment rate that had peaked out at 14.8%. We're now down to 6.1%, which is good compared to 14.8%. But when you think about where we were before the crisis, we were at 3.5%. What we saw from the April jobs report was that non-farm payrolls grow by 266,000. Wall Street expectations were for 1 million. I can tell you, I've been covering these jobs reports for a long time, and I cannot remember that big of a miss. I don't think I would stake my reputation saying we've probably never seen that big of a miss. The economists have been looking at the employment situation largely from a demand standpoint, not so much focusing on the supply standpoint. I think that there may have been an underestimation in terms of just how much of a bottleneck that we have from labor supply right now. There are a host of theories for why we have this labor incongruity in the country. One of them being just kind of an uneven recovery. And that's not just across income groups and gender gaps and racial gaps. It's also geographically. There are just certain parts of the country that are opening faster than other parts of the country go. So while businesses are getting ready to reopen, workers aren't necessarily ready to come back to work. And there are a lot of reasons for that. One is just that I hear cited a lot, just childcare issues. Women right now are lagging very badly in the labor force. The labor force participation rate for women has gone down considerably. And the jobs, as far as just the jobs that were added, are skewing more towards male hires than female hires. I think, of course, a lot of that has to do with childcare issues surrounding the continued lockdowns, continued restrictions. Some of the other theories that are being put out there are just, one that's gaining more and more traction is that fiscal policy, in particular, the move from Congress to continue paying enhanced unemployment benefits, is serving as a deterrent to get people to go back to work. Now, for a long time, economists have been dispelling that, saying it wasn't really a factor, but they're actually starting to look at that a little bit more seriously now that, hey, you pay people not to work, they're not going to work.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves.
One of the overarching problems with tech starting this year is it's a crowded and stale long. People piled into these names last year because of the collapse of the economy and the pandemic. But now we have potential inflation building, interest rates going up. The White House could go after technology. The U.S. economy, not everyone believes it, but it looks like we're set for a full reopen by June. And then capital gains could go up.
I have no doubt, none whatsoever, that we are in a raging mania in all assets. I also have no doubt that I don't have a clue when that's going to end.
I know we talk about semiconductor shortages, and that's a real problem, not just this year, but probably for a year or two to come. And it's not just automobiles, so that has been talked about a lot. The chip shortage will impact computers, will impact K through 12 education with laptops as well as tablets, will impact consumer electronics, health electronics, and so it'll go across the industry, and it is something that the government should take quite seriously.
I think that March was an aberration and April is probably accurate. If I would have told you a year ago we're going to add 250,000 jobs a month, we would have been really excited about that. We look at March and it's like a baseball player hitting 60 home runs one season, and the next season he hits 45, and all of a sudden you think 45 isn't good? 45 is still good. 250 is still good. March was just crazy.
All right, so a critical component of the U.S. petroleum infrastructure remains largely offline for a fourth straight day. The 5,500-mile-long Colonial Pipeline, which supplies 45% of the fuel used along the eastern seaboard, has been shut down since last Friday night when the company fell victim to a cyber attack. Now, it is the largest fuel pipeline in the United States, and President Biden's administration is now involved in getting it back up and running.
By close of business tomorrow, Colonial will be in a position to make the full restart decision. But even after that decision is made, it will take a few days to ramp up operations. This pipeline has never been shut down before.
In the meantime, oil and gas prices are ticking higher, and consumers are starting to feel the pain at the pump. Pippa Stevens explains.
So much of the Colonial Pipeline remains shut down for a fourth straight day, and we're starting to see some impacts now for consumers at the pump. So essentially what happened was the company fell victim to a ransomware cyber attack on Friday, at which point it took all of its systems offline as a precautionary measure. It's really hard to understate the importance of the Colonial Pipeline. It operates 5,500 miles of pipes between the Gulf Coast and the Northeast. It supplies about 45% of the East Coast's fuel supplies, so that's everything from gasoline to jet fuel. So it really is an instrumental part of the United States' petroleum industry. We last heard from the company last night when they said that they want all of their systems to be back online by the end of the week. They also said that one of their main lines was partially up and running on a limited basis, but that it was being manually operated. What we know about the hackers so far is it's a group called the Dark Side. Sources told CNBC they popped up over the summer in August and have been very active ever since. They posted a statement on the dark web saying they feel bad about the societal consequences. But it's hard to think that they didn't understand who they were targeting. It's hard to think that they weren't aware of the effect that this would have. The group said that they are going to more carefully research going forward. They've also said that they give some of their profits to charity, although charities have, in some cases, rejected that money. So a lot of mixed messaging here from the company. Unsurprisingly, Washington is heavily involved in the response. The Department of Energy is leading the federal government's response to this. The FBI also involved. In terms of the consumer, people are unsurprisingly really worried about gas supplies. So we are seeing more and more motorists head to the pump, and that is causing some stations to completely run out of gas. This was as prices were already rising. According to AAA, the national average for a gallon of gas stood at around 2.985 on Tuesday, and that's just a couple cents shy of the highest level since November 2014. So there are some worries that the pipeline shutdown could lead to a further acceleration in the price of gas. However, it's very important to note that this would be highly regional. So while some places in the Northeast might feel the pressures of rising prices, this is unlikely to have an impact on other parts of the country. Additionally, traders are quick to warn that the stockpiles were at very reasonable levels heading into this shutdown, meaning that it probably won't have that much of an impact unless it were to stretch on for a week or more.
Before we go, let's get to our numbers round. We'll start with 12. The FDA approved Pfizer's COVID vaccine for emergency use in kids as young as 12. It's already authorized for adults aged 16 and older. Adolescent access to vaccines will allow states to inoculate students before middle and high schools open in the fall. Public health officials and infectious disease experts say that getting kids vaccinated will accelerate the country's goal of further driving down COVID infections. Shots could be available for 12 to 15-year-olds as soon as Thursday. Next, $749 billion. Americans are paying off their credit card debt at an impressive clip. Outstanding credit card debt in the U.S. totaled $749 billion in March, according to Equifax. That's 2% lower than the previous month and a whopping 14.5% drop from 2020. Now, lower levels of consumer debt is good news for most people, but not the companies that issue the cards. Credit card companies make money on the interest that borrowers pay on their outstanding balance, and as those balances get paid off, that's less revenue. So companies like Discover, Capital One, and Synchrony Financial all mentioned higher payment rates on their earnings calls. And finally, 4,000. Ether, the world's second largest cryptocurrency, broke through the $4,000 threshold for the first time ever earlier this week. Now, Ether is the digital token tied to the Ethereum blockchain, and it hit the new all-time high after a massive rally in 2021. It soared more than 440%, far outpacing the more popular Bitcoin, which is up roughly 95% since the start of the year. Ether's gains coincide with a broader surge in cryptocurrency interest in 2021. The entire crypto market is currently worth $2.5 trillion. Get the latest on Ether, Bitcoin, Dogecoin, and the entire crypto industry by going to CNBC.com and downloading the CNBC app. That's it for After Hours. We will be back here in our home office every Tuesday and Thursday, so be sure to catch us then.